Hello, welcome to Accounting Hub. I'm Professor George Scarpin, PhD in accounting, and our topic today is Goodwill according to the IFRS. Guys, subscribe our channel. You will be the first one to know when a new video arrives. And like our Facebook page, Accounting Hub by Dr. Scarpin. So first of all, what is Goodwill? Goodwill represents the unique value of a company as a whole over and above its identifiable tangible and intangible assets. Goodwill can emerge from a company's clientele and reputation, trained employees, favorable business location, and so on. And it is not accountable. Because goodwill can be separated from a company, it is not possible for a buyer to acquire it without also acquiring the whole company or a portion of it. We cannot purchase only the goodwill. We can purchase everything, the whole package. So how do we capitalize cost of goodwill? Fair value of the consideration given in exchange for the company acquisition price, less the fair value of the identified net assets acquired. So, what is net assets? Fair value of all identifiable tangible and intangible assets less the fair value of the liabilities. So, we are talking about net assets, not only assets, because we don't purchase only the asset, we also purchase the liability. And we don't amortize goodwill. We perform the impairment test, just like any other assets. And what is the level of testing? Is the cash generating unit. A cash generating unit is the smallest identifiable group of assets that generates cash inflows that are largely independent of the cash inflows from other assets or group of assets. So when we purchase another company, it is this another company that we are purchasing, it is a cash generating unit. So we compare the value of the reporting unit itself with its book value. If the fair value is less than its book value, an impairment loss is indicated. And the impairment loss is the amount by which the fair value exceeds the book value. However, the recognized loss can't exceed the book value of goodwill because we cannot have a negative goodwill. Okay? If goodwill is tested for impairment at the same time as other assets of the cash generated unit, the goodwill must be reduced first. This is a very important difference from IFRS to US GAAP. US GAAP, it is reduced later. Uh, IFRS will reduce it first. And any impairment loss and asset write-downs are recorded prior to testing the remaining assets. And subsequent reversal or recovery of a previous goodwill impairment loss is allowed. A second difference between US GAAP and IFRS. US GAAP reversal is not allowed. So IFRS reversal is allowed. So how do you do that? Let's go to our Excel file. And guys, all our Excel files, they are free. And the link to download it is in our video description. Okay, now we're good. So here, Skyping Corporation, my fake company, in January 2021, acquired all of the outstanding common stock of the Santiago Corporation. Santiago is the last name of my wife. In exchange for 380 euros, million cash. Scarping assumed all of Santiago long-term liability, which have a fair value of 170 million, and the fair value of all assets are as followed: receivable 80 million, inventory 90, property, plant and equipment 230, and patent 70 million. So, okay, let's do it. The easiest way to do it, in my opinion, is doing the journal entry. So, okay, Scarping is purchasing, so we need to add all of the assets and liabilities. So let's start with the assets. We debit them. 80 million inventory. Sorry, receivable. 90 millions inventory. 230 property, plant, and equipment. Patent 70 million. Goodwill is the number to balance. So how do we balance it? Total credits less total debits. Okay, negative for 70. Oh, that's bad. However, credit liabilities 170 and cash, how much we pay it, we credit cash 380. So the fair value of consideration given, fair value of the cash 380. Fair value of identifiable assets for 70, the sum of our debits here until patent. Fair value of liabilities 170. So the fair value of net assets 300 million euros. So the goodwill is 80 million euros. Goodwill here must match with our goodwill here. At the end of 2021, IFRS requires Scarping to perform the goodwill impairment test. It is required every year for goodwill. The book value of Santiago net assets at the end of 2021 is 4 million euros, including the 80 million of goodwill. So 40, whoops, book value 40 million, 400 million euro. However, the fair value is only 370. So before doing the impairment of property, plant and equipment, patent, inventory, and so on, we reduce our goodwill. So our journal entry will be loss on impairment of goodwill is 30, the impairment cost, and goodwill 30. So the T account here, the goodwill, we still have 50 million euros. So on 2022, we can record a loss maximum of 50 or a profit the maximum 30, because the reversal must be the maximum must be the total of previous losses. So okay, at the end of 2022, the book value of net assets is 380 million, including the 50 million of goodwill, and the fair value 385. So we have a loss reversal here, 5 million euro, because 5 is lower than the 30 of the previous losses. So here, goodwill, we debit goodwill now, and we credit profit on impairment of goodwill. Either loss or profit on impairment, they are regularly expenses or revenues. Here, they are not other comprehensive income. Okay, guys? So that's it. Thank you so much. If you have questions or comments, leave it here or email me at jscarping@gmail.com. Have a very nice day and God bless you.